I recently visited New York City to celebrate my 28th birthday, and if you've traveled to the United States lately for whatever reason, then it's safe to say that you were probably mortified when checking your credit card statement after making purchases with your Canadian credit card, as the Canadian dollar is currently among the weakest that it's been relative to the US dollar in roughly 5 years. I mean, just look at this transaction right here. A $13 Chipotle bowl settled at over 19 Canadian dollars on my Canadian card, which is roughly $5 more than it would have been right here in Canada. In fact, the US dollar has gained roughly 13% on the value of the Canadian dollar, which not only impacts the economic pressure of rising prices on imported goods, but also impacts investments and the Canadian economy as a whole, which is what we'll be speaking about in today's video, as some currency experts and economists aren't anticipating the loonie to strengthen anytime soon. So what does this mean for you? Well, let's find out. Alright, so first and foremost, although a weaker Canadian dollar can benefit certain industries like exports or tourism, well, it also brings its set of substantial financial challenges that are generally going to outweigh the minimal positives, where these can include higher domestic prices and increased costs for any and all imported products, which is what many are seeing with, say, $9 raspberry cartons. Currently, the Canadian dollar is more than 10% undervalued based on purchasing power parity relative to the US dollar, which is actually quite significant considering that 10 years ago, the dollars were at par, with the loonie even surpassing the American dollar temporarily, which isn't something that I think we'll be seeing anytime soon, as projected economic trends for the United States are far surpassing those of the stagnant and declining GDP per capita values here in Canada. Additionally, the gap that we're currently seeing in interest rates could widen even further than they are already due to differing monetary policies between the Bank of Canada, or BOC for short, and the US Federal Reserve, or Fed for short. And so if the BOC implements more rate cuts while the US Fed maintains their higher rates for a longer period of time because their economy is faring much better, well, it isn't then out of the question that this could very well result in pushing that dollar gap to an even higher level, unfortunately. That said, we are seeing the US Fed announcing potential upcoming cuts as of September. But this is also in parallel to the BOC that's also on the brink of a couple more rate cuts before the end of 2024. With that said, let's speak about how this will impact Canadian consumers. Among other things, a weaker Canadian dollar results in higher costs for imported goods and services, which directly affects the cost of living for Canadians, which is already a hot topic considering that Canadians are struggling pretty much more than ever to make ends meet due to high food and housing costs mainly. Additionally, Canadian consumers are likely to face higher prices even when shopping locally, which is because when Canadian retailers import goods from the US, the increased costs due to that exchange rate are often passed on to the consumer, and companies just simply aren't going to absorb this increased FX cost. That's passed on to the consumer, which makes the cost of living even higher. Another thing to consider is that a weaker loonie raises domestic prices as well for goods that are generally priced in US dollars, like, say, oil and gasoline, among other things, which become, therefore, more expensive, often leading to higher prices at the pump relative to, say, filling up down in the United States. And finally, food prices are another area where this impact is strongly felt, particularly in items such as fresh fruits, nuts, and vegetables that are imported once again from the US, and that are products particularly sensitive to currency fluctuations. So when the Canadian dollar weakens, the cost of these imports rises. Now, all that being said, although a weakening dollar tends to be a negative scenario for a country and its people, it can have a handful of benefits for investors who have exposure to the US dollar and who have investments tied to US dollar denominated securities, right? So for Canadian investors, holdings in US assets or securities will yield higher returns, of course, when converted back to Canadian dollars, regardless of the actual performance of the underlying asset itself. thus giving you more value for your money. However, buying US dollar denominated stocks right now does become more expensive, as a weaker Canadian dollar means you'll need more funds up front to purchase shares of these investments. So here's an example. I hold a fair bit of US cash and US listed securities, such as say BOO, which is an American S&P 500 index fund, which currently trades at around 500 USD per share. And regardless of the fund's performance, just the fact that it's in US dollars has yielded me roughly 10% over the past 2 years. And the same holds true for the US cash that I'm holding. Its value has increased relative to Canadian dollars, meaning a positive return if I were to convert it back to CAD. Additionally, this situation poses a challenge for the Canadian economy as a whole, though, as it encourages investment outside of Canada because Canadian dollar returns are worth less than, say, in American dollars, thus reducing the value of domestic assets. And when combining this with GDP per capita growth projections in Canada, this is far from an ideal situation. Now, of course, the currency impact on investments isn't going to be beneficial for the masses of Canadians that don't hold USD or US listed securities. But if you did want to purchase US listed securities but currently only have Canadian dollars, one of the most cost-effective ways to do this without incurring a huge fee to convert your funds is with Moomoo. Moomoo is a stock investment platform designed for both beginners and experienced investors, now serving over 22 million users in key financial markets, including the US, Canada, Singapore, and Japan. And in Canada, Moomoo operates as a licensed broker regulated by CIRO and is a member of CIPF, ensuring a secure trading environment. And with its intuitive interface and robust data features, Moomoo is ideal for newcomers, allowing you to trade Canadian stocks, US stocks, ETFs, and options, all from one single account. What's more is that Moomoo offers free real-time quotes, detailed data analysis, and access to company financials, analyst ratings, and 24/7 financial news to help you make informed trading decisions. Additionally, stock trading fees are very low on Moomoo, starting at $1.99 per trade for US stocks and $1.49 per trade for Canadian stocks, which is very cheap considering the amount of value that Moomoo brings to its users, along with their sign-up bonuses, where currently you can earn up to $2,300 in cash rewards or Apple gift cards when transferring your investment account over to Moomoo, along with a limited time 6% cash rebate on cash that's just sitting idle in your account. Now, in line with the topic of today's video being the currency conversion rate, Moomoo has among the lowest FX conversion fees in the Canadian market at 0.09% plus $2, which can be used when buying stocks in US currency or simply converting funds in your account. For example, when using other brokerages to buy US stocks, the currency conversion fee is generally 1.5 to 2.5%, meaning a $1,000 trade can result in fees of around $15 to $25, which is insane. And in contrast to this, a $1,000 conversion on Moomoo would only be around $3. Finally, Moomoo offers real-time market data, meaning you can see real-time price changes instead of relying on delayed data. Additionally, Moomoo supports various international markets, broadening your investment horizons, and Moomoo's custom analysis tools allow you to track and analyze your trades, adjusting your strategies in real time to maximize returns. All of this to say, this combination of features is perfect for investors looking to actively manage their portfolios. And finally, if you were looking to transfer over your investment account, the account transfer process is very simple and straightforward. All you have to do on the app is go to My Account, all stock transfer, fill in the stocks that you want to transfer, and then they'll be transferred within 10 business days. And by doing this, you can get up to $2,300 in cash rewards or Apple gift cards when transferring over your account. And these offers can be combined with the new customer promotions like that 6% APY on your cash. Now that we have a better idea of what's happening with the loonie and how this impacts certain facets of the economy, let's take a look at what might lie ahead. So it's a known fact at this point that the Bank of Canada is lowering interest rates, with 2 rate cuts under our belt already and more that are expected through to the end of the year. But even despite this news, we shouldn't expect a full economic recovery anytime soon from the damage that we've experienced over the past several years. In fact, in its latest provincial outlook, the Fédération des Caisses Desjardins du Québec warns that the economic situation of the country is likely to worsen further before it were to improve, stating that they remain convinced that most provinces will see slower growth in the coming quarters and a full recovery wouldn't happen until closer to 2025 after more rate cuts. And this is because typically changes in interest rates, whether increases or cuts, take around 18 months to 2 years to fully take effect in the economy. And the Bank of Canada has already reduced its benchmark interest rate by 50 basis points and is expected to make additional cuts at its next 4 meetings, potentially bringing that rate all the way down to 3.5% by January, even though that is definitely a bit optimistic. However, according to Desjardins' forecast, the country's real GDP growth is expected to bottom out at 1% by the end of 2024, and even lower growth in provinces that are particularly sensitive to interest rate changes. And we've talked about GDP growth in Canada versus the US in past videos. Canada is not on the right track in regards to productivity and growth. In fact, we're increasing in population, yes, but GDP per capita has been trending downwards for years, essentially meaning that we're less productive per person than other countries like the US. And the reason this is relevant is because the Bank of Canada is cutting interest rates at a rate that's exceeding that of the US, who doesn't feel the same need to cut rates at the pace that Canada does, because the economy is showing more signs of resilience and growth despite rates at 5.5%, which, is just typical for US work ethic. So the bottom line is that the Canadian dollar isn't faring well relative to its southern counterpart and may very well continue to struggle gaining any ground in the foreseeable future, as Canada is faced with economic challenges that aren't as prevalent than in the United States. It'll be interesting to see how the loonie, housing market, and jobs market hopefully improve over the next decade, rather than continue down the negative trend that it's currently been on over the past 8 years. If you want to learn more about the Canadian economy and what's currently happening in Canada, make sure to check out one of these videos right here. And don't forget to check out Moomoo, link down below in this video's description. Thanks a lot for watching, and I'll see you in the next one.